GM, just a quick one before we get going. So, as you know, the Blockmates podcast is for informational and entertainment purposes only. Certainly shouldn't be considered as financial advice. We have absolutely no idea what we're talking about half the time. So, any investment decision you do make should be based on your own research and your own understanding of the risks involved. One more thing as well, there's around 50% of people who listen regularly who aren't subscribed yet. So, if you please could just do us a favor and hit the subscribe or the follow button or the like button. Helps content grow, helps us grow, helps it reach more people like yourselves, and it means the world to us as well. So that's the last I'll ask of you. So yeah, let's get to the episode. All right, welcome back to Blockmates podcast. I feel like I'm keep doing the Still Early podcast an awful lot more than the Blockmates podcast these days. And either way, I keep getting shouted at by Henry, our editor, for not asking people to subscribe because there's way too many people who watch regularly, and we can see on the data on YouTube that aren't subscribed. So if you could do us a favor and just do that right now, that'd be great. But today we've got Anna. I've been pestering Cow Protocol in my Twitter DMs to come on, and she's been so grateful to come on. But Anna, how are you doing?
Good. Thank you so much for having me.
Yeah, it only took about 5 or 6 messages pestering you guys to get someone to come on.
No way. I'm so sorry. I think we have to work on our internal communication.
I wouldn't reply to me either. But no, we've been covering Intents and RFQ and just looking at how I suppose the DEX landscape's been evolving quite intensely on lots of different platforms that we've got: articles, long form, short form. Me and 563, our head of research, we probably butchered it, but we did a research podcast on it. But we took our own intent and brought you guys up an awful lot. And I was like, yeah, let's see if we can get them on. But before we get to it, can you just give us a bit of background, like how many times did you have to bang your head to come and work in this industry full time? And is there a decent route into what you're doing now?
Cool, yeah, for sure. I think I joined in 2017, and before I was working on something unrelated, data analyst at the United Nations, and got really frustrated with all the bureaucracy going on there. And then kind of Consensus is obviously based out of New York. They were having the meetups that I started joining and kind of got hooked into the space, and then decided to jump gears entirely, do something very different. And then in fall 2017, I joined Gnosis. And Gnosis is one of those OG projects that have been around for some time. The founders initially even built on top of Bitcoin. And then in 2017, in March or so, they did the ICO and started to grow the team. So I was fairly early on. I think we were 10, 11 team members when I joined. And back then the crypto landscape was definitely still quite a bit different. I think anyone who's joining today probably is still thinking, oh my God, the user experience is so terrible, but it's way better in comparison, obviously, of how it was in 2017. Back then it was really a true nightmare. And so basically by being part of Gnosis, I went a lot through the pain points that usually startups have when they're trying to grow, and generally to the whole issue of finding product market fit. We were working on predecessor decentralized exchange models that were really interesting but didn't find so much adoption. So I went through a couple of loops of development cycles within Gnosis, and then in 2021 we finally we went back to the drawing board a couple of times, and then we launched what is now CowSwap, and it turned out to be successful. So we decided to take it out of Gnosis, become independent. And then me and my co-founder Felix had all the spin-off discussions with Gnosis, and then in February of last year, we ultimately had a DAO vote that decided CowSwap becomes independent, and since then we have our own little company of 30 people currently, and continuously running the operations of CowSwap and trying to grow.
Awesome. Yeah. If you made it through 2017, 2018, you're still sticking around, you must that's when I joined 2017 and thought I'd crack the markets right at the top of the bull cycle, and then quickly realized that I wasn't a genius. So I stuck around to dig myself out of it. So people will have heard of it, I guarantee. If you're watching this, they definitely will have heard of it. Might not use CowSwap. can you give us like a high level of what it is? Because it's not just another DEX with a cool name and like a great noise when you make a swap. It's like there's a lot going on there. So like, can you give us like a high level and we'll just pick it apart piece by piece?
Sounds good. Yeah, so high level, I would simply describe it as a meta DEX aggregator. So essentially, as a user, if you don't want to do price comparison yourself, but you just want to go to one simple venue and like make sure that you get the best possible execution for your transaction, for your trade, you can go to CowSwap and then you sign a transaction. We can dive into that deeper later, like what the difference between signing a transaction, you sign a message, and what like the difference is to a normal crypto transaction. And then we have a competition of third parties that try to find the best execution route for you. And they tap into all existing on-chain liquidity, but also market maker liquidity. So to make sure that really like you can get the best, how do you say, bane for your buck? What's the issue? Yeah, that's the one. And at the same time, like there's a whole lot of like batching algorithm going on to ensure that you're also protected against risks such as MEV. And then ultimately, yeah, the trade is executed for you, whether it's like tapping into Uniswap, Balancer, SushiSwap liquidity, or partially against market maker liquidity. Or even against, and this is something that is very specific and unique to CowSwap, you can also be matched against other traders. So for example, if I want to exchange Ether for DAI and you want to exchange DAI for Ether, we can directly match you with this other user order. And it also means that you have to pay less gas transaction costs and also not the protocol fees that you usually have to pay when you do a transaction on Uniswap, for example. And yeah, that's essentially it on a high level.
And the last part there of like more peer-to-peer kind of trading, is this the aspect of where the name from CowSwap comes from? Because it's quite a cool play on words, isn't it?
Yeah, that's right. I think a lot of people are wondering why we picked that name, and then like on the outside it seems very silly, but yeah, it essentially has a meaning. So the economic phenomenon of like matching trades peer-to-peer essentially is called coincidence of wants, so COW. And we were like doing like some research into like what are we doing wrong, like why do we not find adoption compared to like our competitors, like what is Uniswap doing better, what is like SushiSwap doing better. And it kind of felt like we are missing this memifying aspect to it. And so we were like, well, there is anyway like this USP, this like specific distinguishing factor that we're focusing on, and the short form for it is COW. We might as well incorporate it into our branding, so we called ourselves CowSwap.
And I suppose that's kind of a product of where we're at now, particularly in the DeFi space. Of there is like meaningful volumes coming in and people who could act as counterparties to one another and trade. I can kind of remember, like, I think was it Ether Delta, one of the early exchanges? They just couldn't get either side of the trades to match up whatsoever, and it didn't actually result in anything. But it's really cool to see that come full circle and it's actually used in actual practice now. So I know the answer to this. I've been using it a lot, and my wife, like, she hears the cow go off and she's always asking me what the hell's going on there. Making a trade. But what's if someone hasn't used the DEX, what is the kind of user journey like for them?
Right. So when you go to CowSwap as a user, you basically the UI looks very similar actually to Uniswap. So you pick your sell token, your buy token, the slippage tolerance, because obviously there's always price movement on chain. So to make sure your transaction actually goes through, you pick basically what slippage you are happy to go with. And then the difference is that you don't sign an Ethereum transaction, but you only sign a message. So you essentially sign a message with exactly those information. This is my sell token, my buy token, the limit price, and the execution period. So for example, I don't want this, if this order doesn't get executed in the next 20 minutes, I don't want it to execute at all. And then you sign your message. And that's it. Then you basically hear a happy moo sound and need to wait for a little bit for your trade to be executed. And then what happens under the hood is that your order is collected in an order book, and there is these external parties that we refer to as the solvers that then engage in a competition by looking at, okay, there's this order in the order book, maybe there's just one, maybe there's multiple orders in the order book. And then they need to find basically the best execution algorithm, and they are ranked based on the extra value that they're providing for the user. So whichever solver, and we have currently 15 or so in the competition, and they're also looking at the 1inch API, they're looking at the 0x API on possible market maker integrations, etc. So they look really everywhere. And then they try to like break up the trades that are in the order book in a way that they can really maximize the value that's given back to the user. They all report a score, and the solver that reports the best score in terms of making the best value for the user is the one that's then being picked as the winner and gets to execute your trade on chain on behalf of the user, and then the user receives immediately the funds in their wallet.
Awesome. So what is actually happening for, say, because there's more complex orders on there as well, right? You've got limit orders and you've got like a TWAP or a DCA kind of function as well. Can, like, past those two products, can you get more complex order types, and is there kind of room for that, and like how crazy can that get?
Yeah, that's actually an amazing question. So we just launched also programmatic orders. Essentially, any order type you can think of, you can express with CowSwap. So like you mentioned, TWAP orders. Imagine that you want to manage your portfolio, but you don't want to do it manually. And you think, okay, I have this $1 million trade, but I want to do a trade on a token that doesn't have high liquidity. So if you were to essentially dump $1 million on this pool on the existing on-chain liquidity, you might get a bad execution. So instead, what you could do is you could break up your trade and say, okay, instead of doing one trade at $1 million, let me break this up into 10 trades and do $100,000 each. And let me execute this either with a time interval of every hour or every day or every week or even every month. And then instead of having to do this manually and like going back to UI, signing a new order when it's time, you can essentially just simply set up one order as a TWAP order, predefine what's the total amount, how do you want to break it up, what's the time period in between the individual trades, what's your limit price you're willing to accept. And then you place the order and it's automatically going to be executed for you. And then you can think of like many different things. You can do this also as a dollar cost average strategy, where you think, okay, I want to like, whenever I get my salary, I want to like use 10% of my portfolio and convert it into ETH at the current market price. There's many different strategies that you can replicate with help of CowSwap's infrastructure.
What about could you post like margin? Would that be possible? So like, say if there was a solver that, say if you put $200 up and you wanted $1,000 worth of ETH, for example, is that possible?
Yeah, theoretically you can do anything. You can also do, let's say, for example, you have a MakerDAO portfolio, right? And you're saying like, oh, I'm taking out a loan of $1 million DAI, and I back it up with my Ether, and like my backup position, my collateral is secured at 120%. But now assume that, for example, your ETH is rising. So basically now suddenly, even you have $1 million taken out, you had it backed up with 120%, but as the ETH price is rising, now suddenly your collateral is covering as much as like 150%. So it seems like too much, right? There's like, you don't have to have so much as part of your collateral. So what you could do, you could automatize this, like a price checker that always checks, okay, how much collateral do I have in my CDP, and whenever it goes beyond 120%, I want to use the remaining ETH, sell them on the market for something else. Or the opposite, you can also like have it as a risk prevention strategy. As soon as my collateral drops below 120%, I want to buy more ETH from the market to ensure and like back up my position to ensure that my loan is secured. Like this, anything you can think of essentially that involves some sort of trade, you can replicate with CowSwap.
Nice. And can you, on the terminology of batch auction, can you enlighten a smooth brain like me, just so I'm 100% sure on it?
Essentially, like you mean what, like how the batching itself is working and like the different benefits it brings?
Yeah. So like just what high level of what a batch auction is. So next time I'm on a podcast, I can mention batch auction and sound really smart.
I'm sure you do already. So I think what is interesting is to go a little bit off also into the history, because batch auction is something that actually also already was mentioned and researched in traditional finance. And I want to go a little bit into the history to explain the background as to like why batch auctions can be so powerful. And yeah, to go into a little bit into traditional finance, I'm sure many people have heard like all the craziness that happens in the stock markets of like having a slight bit of a price information advantage by like having closer access to the exchange. So what happened a few years ago in the United States was that those different market makers that were like trying to really place their bets on the stock exchange market and like optimizing the strategies and like making as much money out of it as possible, they were building this overseas cable between the Chicago Stock Exchange and the New York Stock Exchange to get information milliseconds faster. And then that technology got outdated a year later, even though they spent millions of dollars into this technology. But it was still worth it, right? Because if you have information milliseconds faster, you can front run your competition and make money from it. It's a multi-billion-dollar business. But so the thing is that the same issue also exists on Ethereum or generally in blockchain, but it is even amplified. And why is that? It's because blockchain doesn't have time continuum, right? Like currently on Ethereum, every 12 seconds or so, a new block is produced. But what happens to the transactions before the next block is produced? They're just like swimming around in the public mempool, right? They're visible to everyone. So now if I'm like an uneducated user, and I don't mean uneducated in a negative way, like we should all be uneducated users, right? Like the applications should be so simple that I do not need to understand the technology that I'm using. But what happens today is like me as a normal user, I place a transaction and then it becomes visible in a public mempool. So now external, more professional parties see, okay, this user is placing a $1 million trade and they're willing to spend a whole percentage of slippage tolerance. Let me actually extract this value because I can make a lot of money by doing it. And so what they would do is they would front run your transaction because it hasn't been produced in the next block yet. It's just waiting to be included. So they can essentially ensure that their transaction is put in front of your own transaction. They can change the on-chain price point on the AMM, and then in this way force you to execute at a worse price, and then later on sell the tokens again at a better price. And this way, like, take advantage of your slippage. And this is it's even worse than in traditional finance because you have this block time problem. And it's also a multi-million-dollar business. So this was essentially brought up already as a problem, I think initially in 2016 on an ETH research forum post. And Vitalik responded back then to this post and was like saying, well, one way of solving it is batch auctions. And excuse me, this is essentially now where CowSwap is coming in. Because again, the issue is you have in one single block, you have so many different price points, right? Because you have all these different users who are saying, oh, I want to do this transaction and I'm okay with 0.5% or 1% slippage tolerance. And then for external parties, it's interesting to extract it by reshuffling the different orders in a block. And we have observed blocks where even on like very highly frequently traded tokens such as ETH/USDC, you had 10 different price points that spread across one whole percent in price difference in a single block. And it doesn't really make sense, right? Like, because you already don't have a time continuum. Then in one moment there's a new block being mined. Why do 10 different users get 10 different price points in a single block? And this is then really allowing more professional parties to take advantage of it and take away all the money from the normal users. And excuse me. With batching, you can ensure that all these different people who all want to trade ETH/USDC, they can be matched together. And by doing this, you ensure that they all receive a unique selling price. They all receive the same price point. And this way, you take away this whole opportunity of providing them with different price points and taking advantage of their slippage tolerance.
So, because what I'm personally seeing, and I think the full industry is seeing it, there's fragmentation on fragmentation on fragmentation on fragmentation. If it's a new chain, if it's a different liquidity pool, whether that's kind of V2 AMM or it's concentrated liquidity, and then you've even got different wrappers for the same asset, like USDC, native USDC, XLR USDC. So fragmentation on fragmentation on fragmentation. So it's no surprise to me that people are getting filled at completely different prices, even if they're executing basically at the same time, or even sometimes using an aggregator. But do you think, like, I know this might be a bit of a close question, but how do you think the industry moves forward from here? And I know you could potentially might be biased on this one, but will the traditional kind of AMM be still around? Is there always going to be a space for it because it might still offer the best price? Like, how are you guys internally kind of thinking about that, or even personally kind of thinking about it?
It's a super interesting question, and you actually also touched up on this like very good point of fragmented liquidity. So diving or like explaining batch auctions a bit more, like I did use this very simple example of like user A wants what user B sells and the opposite, so they can be matched directly with each other. But batch auctions can be inherently more complex, right? Like you can have a multi-dimensional environment where even as much as 100 different tokens, or much more than that too, can want to be traded. And like usually you don't have a direct match between buyer and seller, but as long as somehow you can make a ring trade happening where maybe person A wants what person D is selling, and then you can match person whatever Z with person C, you can make this all holistically work. But back to the question of how do I see all this like fragmented liquidity evolving, and there is I think it's no news anymore that normal liquidity provisioning on AMMs is not very profitable. I think even like more than a year ago, there was like 1% from the Uniswap team actually did a public analysis on like the profits that LP providers on Uniswap are making, and as in essence, it's negative. Like it's not a very profitable investment strategy. But you need the liquidity, of course, and there have been, of course, the initial AMM design also has already been improved. Like you have now more concentrated liquidity because the very initial AMM design is also extremely inefficient when it comes to liquidity, because of course you need to think if you have traders who want to do a large trade as much as maybe $10 million, think about how deep the liquidity pool needs to be for this trade to actually get a reasonable price, because it needs to be significantly more in-depth the liquidity on this pool in order for $10 million to go through without incurring something with a like reasonable slippage tolerance, right? And so the evolution from that was essentially to allow for more concentrated liquidity that allows users to deposit liquidity at certain price ranges. But even that is still not very efficient, and it's still also not very profitable for liquidity providers to deploy this liquidity. And I think we are already seeing like a new move into a direction where also there's being researched some AMM designs that are like trying to avoid toxic flow. By toxic flow, I mean that about 80% of our transaction flow on Uniswap and other AMMs is currently arbitrage trading. So it's essentially not real volume from users who want to make a trade, but it's like simply like other like bots, etc., that are like taking advantage of the price difference between different AMM pools and centralized exchanges, and like always ensuring that like the different prices are aligned. And the question, however, is for you as a user, if you deploy your capital into a pool like that, it's like a very basic investment strategy, right? Like it's always ensured that the two tokens that you provide are 50-50, like, or at least like in pools that are 50-50 balanced, that you have this 50-50 percentage distribution between your portfolio assets. But at the same time, you could probably have a smarter investment strategy if, for example, ETH significantly evaluates compared to the other token you have in the pool. You just sell ETH against your token B as the ETH price is going up. So it's, again, this is just to like highlight how it's not the most profitable investment strategy. And so currently there's like different AMM designs being considered that are like trying to optimize this a bit more. So I think that's a development that we will see. But I also think that for tokens that are more of the long tail tokens, you know, like the beyond the top 100 tokens, I think it's unrealistic that we will have, especially as more and more tokens are being developed and come to the market, that all of those will have significant liquidity. So I think batch auctions is going to be a model that we will see more around in the future. It might still take a couple of years though.
Yeah, absolutely. And how it's like mentioning long tail assets there. What is it completely down to the solver if they're actually going to create a market on, like, say there's a brand new asset that comes onto the market? Is it like how does that dynamic work? Because I suppose with you guys acting as a meta aggregator, you could probably route it through there anyway, because it's going to pick it up through a different aggregator itself. But what do kind of the solvers kind of want to see to actually be integrating and making markets for longer tail assets?
I think it's ultimately a question of competition. So we have a lot of different solvers with different strategies. Some of them are more simple, and they essentially they just aggregate the aggregator. So they check if 1inch 0x Paraswap. So, for example, as long as one of them has the token indexed already, or like the new liquidity pool indexed, there would automatically be a price quote, and it would automatically be the transaction channel through those to those pools. And then there's other solvers who are much more actively involved in like looking into new opportunities of new pools that are being created, and ultimately it's to their own benefit, right? Like, because the way that the competition is currently rewarded on CowSwap is to check how good is the solution, how much better is the solution of the solver who wins compared to the second best solution. So the better you are able to show a more sophisticated route compared to the other solvers, the higher is your reward. So if your solution is only 1 cent better, this is as much as you get as a reward for finding that solution. But if you are more up to speed with new development and you already tap faster into new liquidity pools, you're more likely to find more sophisticated routes, and your reward is higher that you receive at the end of the day. So that in itself like drives a lot of the competition on CardSwap.
Yeah, and could a solver actually just be an aggregator itself? Like the different types of solvers, I know they'll have different strategies, but is there a dynamic there?
Yes, exactly. So I think the 0x team, for example, is also looking into operating their own solver on top of CowSwap. So basically, they would just deploy their own algorithm. But other solvers that we have, exactly, they all have their own algorithms, and they're all differentiate. And of course, they keep them closed source because this is like the whole business. But there's they really follow different strategies. And then there's one, for example, that's really highly optimizing on finding these potential batches. But yeah, they're all running their own algorithm of like that. So that's why the product ultimately is so sophisticated, right? Because 1inch, for example, has like one team that's working on finding the perfect trading algorithm, but you will always have like sophisticated players that find maybe for certain edge cases a better execution algorithm, or that are faster in adding the newest liquidity. So if you only have one algorithm, the chance that you're the best 100% of the time is basically close to zero. And you see that in our competition dashboard. Like we have a fairly evenly distributed competition rank. And I think the best solver makes maybe 30% of the transactions, in 30% of the cases finds the best solution. Because it's impossible for a single team to like optimize on all different endless possibilities. Like there's so many ways of how you can optimize the execution strategy. You can even look at other existing on-chain transactions and like make sure that the transaction is not backrunnable, or if it is backrunnable, that you already incorporate this into your solution to provide even better price points.
Yeah, I was going to say, I wonder what that distribution of like performance looks like over time, and obviously you tend to see basically everything plays out the same way, where you kind of get a collective bunch of people at the top and just the general distribution. But yeah, because I suppose like in our side of the industry, it must be like a relatively new kind of venture for people to tap into. I seen like there was a Delphi report saying it's typically your 1inches and 0x's of the world that were providing the most, well, being the like heaviest solvers, and now you're starting to see kind of like independent players come in. But what are you guys kind of seeing? Is there like a bit of a how would you put it? Is there a lot of like development happening in that space? Are you seeing more people come in, more people like try and like productize that and offer it as a service? Like, what's it like from your perspective?
Yeah, I would definitely say it has increased. Like, I was really positively surprised when we initially opened the competition like a year and a half ago. It was during East Amsterdam, is when we ran like the first workshops for like trying to get external teams excited about building a solver. And I was really like not pessimistic, but skeptical about like how easy is it gonna be? It's like really mathematical. It's like not a lot of people have that skill set. But somehow we managed to really well like nerd snipe a couple of people who like got super excited about it. And then immediately managed to kick off 2 solvers that are still today in the competition and doing actually amazingly well. And then over time, more and more joined the competition. But I think also, of course, now that more systems are changing to an intent-based system, and it's becoming so much more hyped and popular, I think it has like reached another level of like announcement wave and like excitement, and like people now trying to build their own solver. So we have increasingly seen that market makers are now also participating in the competition. And of course, they also have like a slight advantage in the sense that if they have their own liquidity, they're like in certain price ranges, they are really good at like quoting prices, right? Better sometimes than AMMs. So they have a like slight advantage there. But ultimately, it's good for us because it's good for the users. For the users, the higher the competition, the better, because the more we can ensure that they really get the optimal execution path and the optimal price point. And I think there's been discussions now that people are worried that there's like more and more of a vertical integration of who's running a solver and who's running a searcher and potentially who's running a block builder. I think it's not unlikely because it's somewhat of a similar skill set that you need to require to be a solver and find the best execution algorithm versus what a searcher is doing. But we haven't necessarily seen it yet. I wouldn't be surprised if a bit of that is happening. But I think right now we still have a very, very healthy competition of like also individual teams who are doing fundraising to like scale up the operations. And so far the competition, yeah, is really healthy and it keeps growing. So again, like I think we have 15 or so external like solvers that are operating, and every other week another party is reaching out and like potentially interested in operating their own solver as well.
Awesome. Yeah, because like I heard, you hear a few bits and pieces from people who obviously haven't looked into it as much as they should have, just being, I suppose it's kind of reasonable pushback, just saying, well, it's not exactly democratizing access for people to be a market maker. But my response to that is, I know a lot of people in this industry, they should not be making markets. So it's like, I suppose it's we'll just have to see how it plays out, how it can become more of, not accessible to everyone. I don't think it should be accessible to everyone, if I'm completely honest. I think it's not exactly something that everyone wants to do. You can obviously go make markets and provide liquidity on an AMM, but it'd be interesting to see if anyone tries to turn this into a product and kind of tries to democratize it and tries to like kind of crowdfund it and have their own solvers, then there's going to be like rev kickback and share and stuff like that. But yeah, I'm interested to see how it all plays out, particularly against a lot of the AMM developments with like a UniV4 and like hooks and how all that plays out. But yeah, it'd be quite interesting. From like a protocol perspective, is there like, how does the cow token play into this? Is there like a fee for, like, how does that all work, and like what's the dynamics there?
Yeah. So right now, what happens is that we basically do provide rewards to solvers in cow tokens, and this is essentially, as I mentioned before, split into how much better, like how good is the execution that they're providing compared to the second best bid. And then secondly, it's also rewarding for continuity, because you want to ensure that like you have a healthy competition that is continuously running, even if maybe like on certain token pairs a solver feels like they have a disadvantage or they're not as good as the others. It's important that you have this healthy competition of like everyone providing solutions, that in case that one solver fails, there is a good backup solution in the system. So we reward this on a weekly basis in cow tokens. And so far, we haven't charged users anything. I think sometimes users get confused because they trade on CowSwap, and like we are very open, and I think that's good, about fees in general. But so we show, oh, there's a fee. And why is there a fee? It's not because you're paying anything to CowSwap, but it is because it's like you sign a message and not a transaction. That means the on-chain execution is done for the user. That means you as a user, you're not needing to hold any ETH in your wallet because you're not paying for the on-chain execution. But of course, it costs gas. And what happens is that the servers are paying these gas costs for you, and but then it's taken away from the sell token of the user. And we are very upfront about it and show it into our UI. This is estimated like the execution cost for your trade. And that is being shown as like a fee in the side token of the user. And so users sometimes mistakenly think, oh, I'm paying fees to CowSwap, even though all they're paying for is essentially the on-chain execution. So that's the system of today. But we are actually thinking of starting to charge a fee. But nothing to be too worried about, because we are looking into very sustainable ways of doing this. And I think we first of all, why are we doing it? It's because we think that as a company, we also want to be sustainable. You know, we don't want to be dependent on like this typical pump and dump token and like, let's do another investment round and another investment round. But like, maybe that's a little bit our like German mindset to it, but it's like very much let's try to be sustainable. And like make sure we are like not overspending and like not relying on like too many external parties for investment. So we are looking to introduce a fee, but only on the value add that we are providing to users. So often, because we have this batching mechanism that allows us to save gas costs for users, to avoid protocol fees for users, to provide less price impact, we have price benefits that we usually refer to as surplus to users, basically a better price than they would receive anywhere else. And here, do not be mistaken, because that's also another mistake that users sometimes do. They go to basically the Chaos of UI, and then they compare it with Uniswap or 1inch, and they see, oh no, but 1inch is giving me a better price. The UI always only shows you an estimate. What is really interesting is to look back into your wallet after the trade has happened, because in 65% or so of the cases on Chaoswap, you actually get a better execution than what the UI shows you. And on some other exchanges, don't want to say names, you don't ever receive a better execution than what is shown to you in the UI, and often you get a worse execution. And so what really is interesting is ultimately not what the UI shows you, but what ultimately happens on the blockchain and ends up being in your wallet. And again, like, we are very transparent and conservative, so we don't want to overpromise. But yeah, so often the user receives a better amount, and then this is where we want to start charging a fee from, where basically, hey, if you got a better execution than anticipated, we take a cut from this. And to make it more clear, or like even more obvious, is we launched limit orders more than a year ago. And usually for limit orders, you get exactly the limit price, right? You say, okay, if Ether hits $2,200, I want to sell my Ether. Everywhere else, you get it exactly executed at $2,200. But on Chaoswap, sometimes you get it executed at a better price. So maybe you get it executed and you get $2,300 for your trade. And then on this difference, on the additional $100 we're giving to the user, is where we would take a cut from.
That makes sense. That makes an awful lot of sense, to be honest. Instead of just putting a, no names mentioned, just a fee for using the front end. Sure, everyone will know what I'm talking about that.
Yeah. No, but the worst part of that is that the money doesn't go to the token holders, right? On Uniswap, this is like, it feels a little bit like a slap in the face.
Token not needed. That was awesome, Anna. Thanks. Is there anything else I might not have asked that you would like to like leave the listeners or viewers with? If there's anything like important that you think people should know?
Maybe one thing like that's interesting to add as well is like, where's the whole Intents space growing to, right? Like, everybody's hyping Intents, and honestly, I think they're maybe a little bit overhyped. It's like this moment where everybody loves to talk about it. A lot of people don't really understand what an intent is yet, and are like also awfully using it to raise funds for like ideas that are maybe not all equally workable. But it is a very interesting space because it offers a lot of opportunities. Like I mentioned at the very beginning how terrible the UX was 2017. To be honest, it's still pretty terrible today, even though it improved a lot. But of course, if you want to have the next adoption race, like the next wave of users coming in, the UX needs to improve significantly more. And I think this is where Intents can really help, because it allows the user not to know exactly how the execution environment works, like they needed to until now, but it allows them just to express their wishes, right? It allows them to express, oh, this is ultimately the outcome I want to achieve. I don't care how you do it, just do it for me, and then allow someone else to do it for the user. And I think an example that maybe a lot of listeners know the pain points about is today's bridging environment. Like you have so many fragmented chains, and like that also leads to more fragmented liquidity. And then me as a user, I'm like, oh, I really want to buy this token, but this token is like only has deep liquidity on this other network. So now I need to like go to a bridge. Like I'm worried, it takes a long time. I don't know exactly how it works. I need to find a good bridging provider, bridge my funds over, then do the liquidity there. But then ultimately I want to hold it again where I hold my other funds. So I'm bridging it back or whatever it is that the user's doing. And then needs to know about like who as a user wants to know that there's like Binance, Polygon, Optimism, however they're all called, and like what the differences are between those chains. Me as a user, I shouldn't really have to worry about this. And Intents are able to abstract this away. So as a user, and it's something we're working on, I could go to CowSwap, not yet, but hopefully soon. And I just basically select, I want to have this token. And then that's it. But under the hood, the solvers, our competition, can see, oh, actually, for this token, I have a much better liquidity pool on this other network. They bridge the token for you. They exchange the trade there. They bridge it back to you. Or if you say I want a different destination chain, they can deliver it somewhere else. And
Awesome.
yeah, we launched Cow Hooks. That's essentially allowing to put any type of transaction before or after your swap. And that gives like this modularity to solvers to essentially do a whole chain of different transactions in a row for the user.
Nice. I mean, that'll save me an awful lot of time and headache if I can do that. Honestly, I've missed out on so much stuff by just being too lazy to actually go through the bridging process because it's just painful, to be honest. Like I know there's people out there doing good work, but come on.
It's horrible UX. Like there's so much horrible UX to it, but it's gonna get better. We just need to keep grinding, keep working on it. And I think Intents can really help us those.
I agree. And we were probably one of those people shouting loudly about Intents without understanding what we were talking about. So I hope we didn't overhype everyone too much. But Anna, thanks so much. Welcome back anytime. If there's anything you're rolling out, just let me know and I'll jump back on. But yeah, where can people find you as well, and we'll get it wrapped up.
I think I was gonna suggest Twitter, but now that you told me you had such a horrible time reaching out to us, I'm like hesitant in recommending it. We also, I do admit, like we were a little slow on responding to Twitter responses. You can also reach me personally on Twitter. I try to be more active. It's Anna MS George. And then CowSwap itself also has a Discord, and there we're very active in responding fast. So that might be your best option.
To be fair, it was on my personal account as well. I probably wasn't checking it for a good couple of days, so it was on me. But thanks so much for your time. Best luck with everything, and anything we've talked about, people who are listening, it'll be in the description below. And yeah, we'll see you next time.
Thank you so much for having us. It was really nice. Talk soon.
Very welcome. Take it easy. Bye.